Welcome to the deep dive. Today we're zooming in on a company everyone knows, the Coca-Cola Company, ticker KO. You see them everywhere, right?
Absolutely. And our mission today in this, focused deep dive is pretty straightforward. We want to pull out the key insights on Coke's current financial health, what's potentially coming next,
Right.
based on, well, a whole stack of info, stock reports, their latest earnings call, news bits, historical data, basically get you the crucial stuff fast.
Okay, let's do it. So the stock itself, last close was $72.40 USD.
Yep. And the sources we looked at put the fair value around $73.57.
Yep.
There's also this, our price target mentioned at $74.08.
So pretty close to where it's trading now, and that's within the 52-week range.
Yeah, the range is $60.62 on the low end and $74.38 on the high. So it's definitely near the top of that range currently.
Something that really stands out is this wide economic moat rating. Can you unpack that a bit? What does that actually mean for someone thinking about the stock?
Right, the moat. It's a really significant indicator. It basically means Coca-Cola has these like deep-rooted advantages, things that make it super hard for competitors to really challenge them effectively long term.
Okay, so what are those advantages? What gives them that moat?
It really boils down to two main things. First, just sheer brand power. Think about it. Coke, Sprite, Fanta, Minute Maid. They're like this huge portfolio. Global brands, local favorites, decades of loyalty built up.
Yeah.
Exactly. And second, their distribution network. It's
Yeah.
just massive. A logistical powerhouse, getting drinks onto shelves pretty much everywhere, trying to copy that. Incredibly expensive, incredibly complex.
That makes sense. That combination sounds tough to beat.
It really is. It creates this, durable competitive edge.
Okay, let's pivot to how they've been doing recently. Q1 2025. What did the numbers show?
Well, overall, the results looked pretty resilient. They had 2% global unit case volume growth, and organic revenue grew 6%, which is actually at the high end of their long-term target range.
6% organic growth. That's strong. What drove that?
Yeah, it's a key number. And it was largely driven by pricing power. They managed a 5% bump from price and mix. So they charged a bit more, and maybe people shifted to slightly more premium options within their lineup.
Interesting. So even if volume wasn't exploding everywhere, revenue still climbed nicely.
Exactly. And their profit margins, comparable gross and operating margins, they expanded too. Another positive sign.
But I gather it wasn't all rosy, and North America volume was flagged as unsatisfactory. What happened there?
Yeah, that was a weak spot. A few things were mentioned. Weather, some calendar timing issues, but also, and this is maybe more concerning, weakening consumer sentiment,
Oh.
particularly among Hispanic consumers, apparently linked to some kind of false video circulating. And it hit the grocery store take-home sales channel harder.
That's a specific issue. Does that challenge that whole resilience idea we just talked about? How big a deal is that dip?
It's definitely something to watch. And it wasn't just North America. Mexico's volume was also softer, partly because they were comparing against a really strong period last year, but also some similar consumer sentiment issues tied to geopolitical stuff affecting Hispanic consumers there too.
Okay.
And then you had mixed results in Europe, parts of Asia-Pacific like Thailand, Indonesia. Volume declines there too. Even Fairlife, which has been a growth star for them.
Right, the milk brand.
Yeah, that growth is expected to slow down a bit just until they get more production capacity online.
So quite a few headwinds then, financial ones too.
Definitely. Currency exchange rates were a drag. The effects from selling off bottling operations are still filtering through. Higher interest costs, higher taxes. But, if you strip out the currency impact,
The underlying picture.
exactly. Their comparable currency neutral EPS, so earnings per share without the currency fluctuations, actually grew 6%. That suggests the core business is performing quite well. And free cash flow improved too, year over year, if you exclude a payment related to Fairlife.
Okay, so they're generating cash. What are they projecting for the rest of 2025 then? Still feeling confident?
They've actually maintained their full year guidance, which, in this kind of uncertain environment, holding firm on guidance is often seen as a positive sign.
What is that guidance?
They're still calling for 5% to 6% organic revenue growth for the full year and 2% to 3% growth in comparable EPS compared to 2024's $2.88.
Okay, but you mentioned the currency headwinds.
Right. And they expect those to be pretty significant for the full year, potentially hitting comparable EPS by like 5% to 6%. That's a big chunk.
Wow. So if you look past that currency impact again, what does the underlying growth look like?
Well, doing the math, their implied comparable currency neutral EPS growth forecast is now actually stronger. in the 7% to 9% range. So the core operations are expected to perform quite robustly.
And cash flow.
They're anticipating around $9.5 billion in free cash flow for the year, again, excluding that Fairlife payment. And they plan to reinvest about $2.2 billion of that, mostly on capital expenditures, like building more capacity for brands like Fairlife.
So it sounds like they have clear plans to tackle those weak spots, like North America and Mexico.
Oh, absolutely. They talked about prioritizing investments where they'll have the most impact, making decisions faster, being more agile in those markets.
Specific actions.
Yeah, like specifically trying to win back Hispanic consumers, tailored messaging, focusing on affordability options. They mentioned in Hecho in Mexico campaign. So yeah, they're definitely not ignoring the problems.
And beyond fixing problems, are they still pushing innovation?
Seems like it. Continued investment in Fused Tea, for example.
Right.
Testing new things like a Simply Pop prebiotic soda. Bringing back the Share a Coke campaign globally, but with more of a digital spin this time.
Ah, share a Coke. I remember that.
Yeah. And their marketing generally is getting more digital, more data-driven. They mentioned something called Studio X, helping tailor campaigns. Expecting some productivity gains from that later in the year.
Okay. Now, every investment has risks. What are the main ones to keep an eye on for Coca-Cola?
Well, the big picture stuff is always there, right? Global trade tensions, general economic uncertainty that can always dampen consumer spending.
Tariffs.
They currently view tariffs as manageable, but that's something that could change, obviously. We already talked about geopolitical tensions hitting consumer behavior in places like Mexico, and just the potential for the broader economy to be a bit choppy, as they put it. These are things you, as a potential investor, need to factor in.
Makes sense. Let's quickly touch on dividends. Coke's a big dividend payer, isn't it?
Oh yeah, a classic dividend king. They just declared their regular quarterly dividend, 51 cents a share, payable July 1st. They have this incredibly long history of not just paying, but increasing dividends. That's a huge draw for income-focused investors.
Right. And what's the general vibe from analysts covering the stock?
Generally positive from what we saw. Recent news mentioned some price target increases, like Jefferies bumping theirs up to $77. The overall sentiment seems to be that brokers consider it a good, solid investment.
Okay, so let's try and synthesize all this. What's the core investment thesis for Coca-Cola right now, summing it all up?
I think it comes back to that wide economic moat. The brands, the distribution, that's the bedrock. They have a proven long-term growth model,
Yeah.
even with these headwinds popping up.
And they generate a lot of cash.
Exactly. Robust cash flow generation lets them invest back into the business and return cash to shareholders reliably through dividends. Now, you absolutely have to acknowledge the near-term volume softness in key places like North America. That's something to watch closely.
But they are addressing it.
Yes, their strategic initiatives show they're actively working on those challenges. So for you, the potential investor, it looks like a mix of stability, that long-term moat, and growth potential, but yeah, with some current hurdles to navigate.
So a picture of resilience and long-term strength, but definitely facing some present-day market issues.
Precisely. And it kind of leaves you with a thought, doesn't it? Given how established they are, but also how they're trying to adapt. How will all these shifts in what people want to drink, the health trends, the new categories, how might that ultimately impact Coca-Cola's dominance down the road? It's a really interesting question to mull over.
Absolutely is. And for you, our listener, if this focused deep dive into Coca-Cola gave you some valuable insights on what's driving the stock right now, please do subscribe to our YouTube channel. We do these deep dives regularly.
Yeah, and definitely hit that bell icon. That way you get notified whenever we release new content, and it really helps support the channel.
It really does. Thanks for diving deep with us today.